How's it going, everyone? Let me know if you can hear me since I've had a little bit of mic troubles recently. Hope you're doing well. Nick should be on here in just a second, and Aaron Marburg as well. So just wait. There he is. Aaron, you're being promoted to panelist right now. Let's try that again. There he is.
All right, I got promoted.
You are officially promoted.
All right.
I'm also promoting Nick too, so let's see. How's it going?
Doing all right. How are you doing?
I am doing pretty well, all things considered. I feel like
it's a relative question these days, right?
Yeah, I feel like you have to throw in the all things considered, otherwise you sound kind of insensitive. If you're like, I'm doing great, life is so awesome.
Yeah.
Wait.
Yeah. Great. Doing great is couched with the fact that I'm absolutely stir crazy because I haven't left my house in God knows how many days.
Yeah, no reason to count. That's fine.
A lot of days.
Well, cool. Well, thanks for coming back on. Appreciate it. Yesterday, Kim and I, my wife and I, were talking about how back in February we were in Hawaii and how that feels like forever ago. So I'm trying to channel Hawaii again with my crazy shirt today. So hopefully you guys can feel the sunshine from the combination of my incredibly pale skin contrasting with my Hawaii shirts. So with that in mind, when we chatted a couple weeks ago, we went through a few different buckets. We talked about just kind of a macro view of the economy. Then we got into kind of Bernstein's perspective on liquidity, solvency, and then basically fiscal stimulus. And of course, a lot has changed in that regard since. So I'd love to kind of revisit those buckets, if that's okay with you, and see if there's anything that has changed, and if from your guys' perspective, or we can just kind of, and I think it's relevant to understand what has changed, or if anything hasn't changed, why that's the case. So we'd love to kind of work through those buckets. There are a number of kind of new faces, names attending today. So if you wouldn't mind first kind of giving your spiel of who you guys are.
Yeah, happy to do that. And then I'll dig in kind of a pseudo recap of a few weeks ago, and then talk about where we're at today. Because look, I mean, in this day and age right now, 2 weeks might as well be 2 years,
right.
It seems. So for the new faces that are listening in, my name, so I'm Aaron Marburg. I'm an advisor with Bernstein, or Alliance Bernstein. For those of you who aren't familiar with us, Alliance Bernstein is a global wealth management and research firm. We have again, global, we have offices all over the world. The other thing that I would share with you, I think that makes us really unique and in a really good position to talk about this right now is, look, our firm is narrowly focused on doing research and wealth management, period. So we're not a bank, we're not an insurance company, we don't trade our own capital for profit. We just do research and then leverage that on our clients' behalf. So, Dan knows this all too well. I mean, I pound the pavement on research over and over and over again because it's the cornerstone of who we are. It's what we've been known for over 50 years now. And we leverage that research network all over the world to form our own opinions and thoughts about economies and trends, both domestically and internationally, on down to how to think about investing in different companies and different pieces of the capital markets. And that's only one half of the research. The other half of the research, which maybe I'll touch on the end, revolves around how to help people build better plans for their wealth. So we do have a group that's made up of about 40 people that are focused on, how to help people understand, when they can retire, they own and operate a company. How do they think about that within the context of their longer term plans and things like charitable goals, and how does wealth impact the family? So I'll probably kind of finish with touching on how I think people should be tying their planning back to the actual investment side of their wealth. But let me start with kind of the first leg of that research, talking again about
Before you do that, Aaron,
yeah.
I forgot to say, if you guys have questions, drop them in the Q&A, not in the chat. A little bit easier for us to manage through the Q&A.
Yeah, drop them in Q&A, and we're gonna let Aaron roll. So if it needs context, give it context. So if you have a question, just make sure we know what it's regarding at the end.
Perfect. Yeah.
Sorry.
Yeah. And I'll go through some things. And of course I've got ample time to tackle questions that come in. So, sorry, go ahead.
And then the other thing, just because you're always so modest, is that you mentioned all that research, and you guys consistently win awards across the board in terms of your research, and I don't know, spend hundreds of millions of dollars on it, and manage somewhere around $1 trillion. So you have enough money that you're managing to have some perspective. So I just want to add those because you're always so modest about what you do in the awards and all that sort of stuff. So anyhow, I won't cut you off.
Thank you. Yeah. Yeah. Well, and look, we do kind of joke that we're the biggest firm nobody's ever heard of because, the way we think about it is we don't advertise, right? You don't see us sponsoring golf tournaments or running TV ads or anything like that. The way we think about it is that we'd rather take quote unquote marketing dollars and pour that into the research. And then that, that defaults to your point about, yes, our research platform across the board is consistently ranked number 1 or number 2 in every category we work in. So it gets back to, I think we are really well grounded to talk about what's going on right now. So what I thought I would do is I'll break this into a couple pieces. I'll talk a bit about the economy, talk about the markets, and then just share some things that we're doing, how we're thinking about it. And look, speaking to the economy, I think calling this strange times is probably the understatement of the century right now. Obviously we got massive job losses. We saw the unemployment benefits number today. A lot of us are in quarantine. We don't want to minimize the health risk, and people are losing loved ones. There's economic challenges. We're in a bear market. I would argue that what's going on right now is mentally more challenging than 2008. But I would also say that this is not 2008. In that 2008 was a recession built around a potential collapse of the entire financial system. And that's not what we have right now. What we really have is a temporary halt to economic activity. And I think that's fair to say. I do think this is temporary. This will be behind us at some point, but it is a halt to economic activity. And look, we're in a recession. I know I shared this, I think a couple of weeks ago, that was our thought. But I don't think there's any question about that. And I'll share some thoughts about how we're thinking about that. Look, we can't slap certain numbers on the economy right now because there are so many variables. But you mentioned, Dan, there were a couple things that we're keeping an eye on. 3 real key metrics that we're observing in light of this. One is liquidity risk. The second is solvency risk, and the third is public health. And look, liquidity risk, that revolves around, that's the 2008 concern. Does the plumbing of the financial system still work? Solvency risk has more to do with, all of us, people and small business. Do we have money in our pocket? Can we essentially keep ourselves afloat as we get through this? And then of course, public health revolves around the virus, the pandemic itself, and what sort of resolution might we see there? And, when we spoke 2 weeks ago, the liquidity risk is something we were comfortable with, and we still are. The Fed has taken a very aggressive approach to providing support to the financial system, and look, that's provided very good optics. They made it abundantly clear even 2 weeks ago that they're going to again back up liquidity in the system. So we're still seeing that. The solvency risk, that's been 2 weeks ago, that was very different. It was pretty unclear exactly how phase 3 of the stimulus would play out. At that time, it was $1 trillion was kind of the number that was being floated around. And again, we know that's changed. And then look, 2 weeks ago, from a public health policy standpoint, I would argue that in a lot of ways it was a pretty fragmented environment as far as how, particularly we look at the U.S., how different states were responding to the crisis. So look, yeah, a lot has changed because I think the liquidity risk in monetary policy, that's still pretty much the same, and that the Fed's taken a very aggressive approach through lowering rates, reactivated quantitative easing. They've activated a number of programs to support liquidity throughout the markets. But again, the fiscal policy to address solvency risk, that's changed quite a bit. We saw that, of course, the phase 3 became a $2 trillion plan, which is very sizable. Which I would also say that from an optics standpoint, that's a good thing as well, because it's a very big statement that says that from a congressional standpoint, they're ready to provide a lot of support to the economy. And let's be clear, this is triage to support the economy until we get past this. And again, I think you've had calls talking with people. I think people are probably pretty clear with what's in there. The direct payments, the PPE loans that can flip into grants. Bailouts for certain industries, which I know that's a bit of a dirty word ever since 2008. But what I would share is that, look, we need airlines when this is all said and done. We need to be able to travel, and there's been contingencies being slapped onto those bailouts that to ensure that those don't turn into executive paydays. So again, a lot's changed on that. Again, fiscal stimulus plan phase 3 got much bigger than what it looked like it might be two weeks ago, and they're already talking about a phase 4 plan. And then the public health policy standpoint, look, you've obviously also seen massive steps taken in that regard. 2 weeks ago, it was a really fragmented approach. Each state was taking a very some states were taking a very heavy-handed approach, whereas many weren't. And I think I saw the number was 80% of the country's on lockdown now. So again, you're seeing things are changing on that front as well and progressing in the right direction. And from our standpoint, look, the progression that we're seeing on those 3 key factors that we're watching, here's where it kind of puts us. Our expectation, as I said, that we're in a recession. Our expectation is that second quarter GDP probably contracts about 20%. Now, look, that's subject to variability. The number could be smaller, it could be bigger. But we do think we'll see growth in Q3 and Q4. And our full year number right now, we think quarterly economic growth, or lack thereof, I suppose, is we actually expect a contraction of about 2% this year. But again, I couch that with saying that again, there's so many variables at play that we're literally evaluating these things on a daily basis to see how things are changing. So it's going to be bumpy. There's no doubt about that. But we do think that this is something that eventually we're able to move beyond, and we see some growth in the back half of the year from an economic standpoint. So then the question is, all right, pivoting into the capital market or the markets, right? Let's talk about the markets from
just
cash.
Can we clarify real quick on the GDP growth? So when you're looking at GDP growth, you're comparing it year over year, correct? So we're talking Q2 relative to last year's Q2.
Yeah, well, no. So we think. So you're talking about it's a relative to GDP figures last year, correct? Yeah. So we think, Q2 GDP will contract 20%. So again, that's a sizable contraction. But if we're talking full year numbers, for the full year relative to last year, yes, we expect a contraction in the economy of 2% this year.
Great. I just want to clarify that for folks, because if we're talking about a 20% decline in Q2 of this year, that's relative to Q2 2019. So when we get the 2%, was it 2% growth that you said in Q3 and Q4? That's not 2% on the 20% reduction. It's 2% relative to last year.
So the better way to say this maybe is basically think about the economy this way, right? We think you got Q1 maybe kind of flattish, probably down at the end, right? And then Q2 is going to be just a drop off in the economy. But then we expect a rebound in Q3, Q4. And on the full year, we expect contraction in the economy for 2020 of about 2%.
Perfect. Yep. Just wanted to clarify that. And then in our last conversation, we talked about kind of your guys' perspective on GDP growth for next year with respect to the U.S., but also in relation to Europe and to China. Have any of those numbers changed in terms of your guys?
Not particularly, but I mean, look, it's kind of it's a. I mean, look, it's still recession in most of the world. I think Europe in particular. We do think, I think I shared last time, that we do still think there'll be growth in the Chinese economy this year, but on a relative basis, very disappointing growth. I think the number was 4%, which for them is an utter failure. And for us, looking into next year, we expect at this point GDP growth next year of around 3.5%. But I think part of the thing that's important to remember too is that essentially what's you've had this kind of trend of economic growth going on, and what we're seeing now is we're going to see this cratering dip, and we do expect a rebound that'll help us recover and grow, but it's going to be a realignment of growth because we're not going to get quite back up to that trend line that we were already on, right? So we do expect a rebound growth, but it's going to be different. We're not going to be, it's not like 6 months from now we're going to say, okay, hey, we're right back where we were. It's going to take some time.
Right. Because that 3.5% growth next year accounts for the 20% reduction from Q2. So relative to what the total size of GDP would be in 2021 compared to 2019, we're still net down.
Exactly. Yeah. It's 3.5% growth can be great, but look, when you grow 3.5% from a much lower starting point, it's you're not back where you were.
Great. All right. Sorry to derail again, but
no, that's okay. That's okay. So then the question is, all right, how do you think about this as you pivot into the markets? And again, the way I kind of thought about this was you think about just the broad range of asset classes. Talk about cash, bonds, stocks, and then alternatives. Starting with cash. I mean, let's just be honest. Cash is king right now. It's if it was 2 weeks ago when the sell-off was particularly violent, if it wasn't cash, it was sold. Period. I mean, everything. It didn't matter if it wasn't cash; it was sold. And I'll just look. Money market yields are going to go to zero. Right? They're still going to be stable. They're going to provide what you want. The Fed has backstopped the money market with a ton of liquidity. So money market funds will give you what you want as far as protecting capital, but there's going to be no earnings in that space. And that's because there's a massive amount of demand there coupled with interest rates being slashed to zero. That's just the reality of what we're in. And we saw this back in 2008, very similar thing. So then we move along the spectrum. We look at, say, the bond world. And look, the bond world, typically that's in a portfolio for an investor. That's the piece that gives you risk mitigation. We still think it actually plays that role, but candidly, bonds were really challenged for a period of time. And it gets back to this point about if it wasn't cash, it was sold. Bonds were part of that. Bonds were sold off pretty aggressively a few weeks ago, and bonds are a relatively inefficient market when you compare them to, say, stocks. And what was happening was, you had good high credit quality bonds. If you wanted to sell them, you had a bond that was worth $100. You were having to take a 5 or a 10% haircut to be able to get out. So you saw markdown in valuations in the bond space, but it was much more of a technical thing in nature. And we've actually already seen quite a rebound in bond pricing since then. But look, a lot of sellers and forced sellers that had to sell bonds to get out, to get liquidity, they got crushed from a pricing standpoint. Then we look at the stocks. Look, obviously we know the stock market's been incredibly volatile. One thing I would say is that there is a lot priced into the market with the dip that we've already seen. If we look at the total economic output for the U.S. of around $21 trillion, if you take the most pessimistic, you look at consensus economic forecasts, you take the most pessimistic forecast, they suggest that you see a 7% contraction in the economy this year. That would imply $1.5 trillion getting taken out of the U.S. economy. At the depth of the sell-off, when the markets were down about 35%, you'd taken about $35 trillion out of the market. So essentially the markets had priced in 8x the economic damage that was being reflected in the most pessimistic of outcomes. So my whole point in this is like, look, I won't call a bottom. I never will. I think most people that try to call bottoms are they're going to pull their foot out of their mouth. But what I would say is that, look, stocks are a heck of a lot cheaper today than they were 2 months ago. And there is a lot of very pessimistic predictions around this recession already priced into the market. Everything's been pulled forward to today's pricing. So there is an element of opportunity there. I'll talk a bit about some of the opportunities across all the asset classes in just a second. The last thing I was just going to touch on, though, is we talked about cash bond stocks, the alternative space. And I guess for those who maybe aren't familiar with alternatives, and we've talked about things like private real estate, middle market debt, private equity, securitized assets, basically capital assets that aren't stocks and bonds, things that you can invest in that are different. And look, these asset classes aren't immune to an economic slowdown. And of course, some of them have seen some challenges in this environment without question, but they do have lower correlations to stocks and bonds. And some of them have held up really well. So often they can make a lot of sense in a portfolio. And one of the things that's always interesting about the alternative space as well is often they're not liquid. You know, you can't sell them like you can a stock or a bond. But that's not necessarily a bad thing. I know one of my colleagues that would always say that he liked having real estate as part of his portfolio because when he wanted to sell it the most, he couldn't. Right. And think about 2008, right? I mean, that's when nobody wanted to own real estate, but if you couldn't sell it and you were able to survive the pain, eventually you were made whole on those positions. But you obviously had to hang on for a while. So look, yeah, across the markets, that's kind of how we're thinking about these asset classes. So then the question becomes, what are we doing from an opportunity standpoint? How are we thinking about this? And I would say both from a risk management standpoint and an opportunity standpoint. I said I won't call the bottom, and I wouldn't be shocked if a lot of this volatility persists for a while, right? There's still a lot of things we don't know. So, look, from a risk management standpoint, I can tell you one thing. One of the things we're doing, we have a unique tool that we use for our clients to manage risk in portfolios where we can throttle their exposure to things like stocks and bonds, and we can also manage specific exposure around things like, interest rates or different currencies. And I know we've been using that tool to pull back our clients' exposures to stocks. Very importantly, we're doing that not because we want to pull back exposure to stocks and then get back into the bottom. It's a risk management tool. We pulled back exposure to stocks because we still think risk is elevated, and we don't think we're being compensated for absorbing that much risk. Look, again, bonds play the role of being a risk mitigator, but we've actually also been very active in the bond space to manage risk in two ways. One, I mentioned earlier that there were a lot of forced sellers in the marketplace and people were having to take massive haircuts on bonds. Typically in a client's portfolio, if you've got a balance of some amount between stocks and bonds, big market movements will change that balance, and you would want to kind of rebalance your proper long-term target. We suspended that rebalancing process, right? So the stocks went down, so their bonds became more of their portfolio. Usually we'd sell some bonds to get back into stocks, get them back to long-term target. We suspended that process because A, we wanted to actually hold some more bonds from a risk management standpoint, but B, we didn't want to be that forced seller. And in fact, opportunistically, I said that, bond sellers were having to take these 5 and 10% haircuts. We were actually buying, because that means on the other side, you can be the buyer and you can get into bonds at a 5 and 10% discount. So we were very active in the bond space and using our risk management tool to manage overall risk for clients. And then from an opportunistic standpoint, look, I think first, I talk about alternatives. Again, I think even putting aside what's going on right now, we've actually long held the belief for the next 10 years that capital market returns are going to be lower. And that's just a byproduct of more modest economic growth. We look at where interest rates are at. So the idea of adding assets, alternative assets that can augment return and actually mitigate risk because they're not correlated to other parts of your portfolio makes a lot of sense. So we're certainly encouraging a lot of people to explore that as something that might be right for them. In the bond space, I just gave the example. We've been, again, opportunistically investing in bonds because there's been substantial discounts there as well. And in stocks, again, they're cheaper than they were. There's a certain degree of attractiveness in the stock market because of how cheap they are. Now that doesn't mean you buy everything indiscriminately, because if what's going on right now does persist for a while, you have to be thoughtful about that. So we're really looking for companies with bulletproof balance sheets. We're being very cognizant of leverage. If a company is really living off of debt and this persists for a while, that math doesn't play out forever. But there's an opportunity again to look for really good companies that are suddenly cheap. I know we think there's some long thematic trends around things like electric cars, stuff like that, and semiconductor space will really benefit from that, just as an example. So I know that last year there were companies in that space that we were interested in, but they were far too expensive for our taste. Now they're not. So there's opportunities there. But the last thing, and I'll finish with this, and then hopefully I can answer some questions. All of this, as far as how somebody responds in this environment and behaves, should be predicated on some sort of underlying plan that drives their decisions, right? People really need to know their numbers. I mean, I know, Dan, you and I have talked about this a lot, this idea of core capital. What's the pool of capital that somebody should be looking to achieve that if you had really challenging capital markets in the future, high inflation, you lived a long time, what's the pool of capital that would endow your lifestyle? That should really be the foundation for any decision somebody makes around their investments to drive, again, this plan. And then, by the way, with interest rates as low as they are, there's also some really cool, sophisticated planning opportunities out there, whether it be, different charitable strategies, or if people want to transfer wealth to kids and grandkids. There's a lot of things that can be done in this environment. So
Awesome.
Let me pause there. Just any questions or any?
Let me take a look at the Q&A. Nick, do you want to?
Yeah, it looks like there's some PPP questions. I think we'll save that for later. In light of U.S. leading the number of cases, would like to ask about one, U.S. versus international opportunity for stocks, bonds, and currency, and two, the risk of weakening the U.S. dollar in light of a huge stimulus.
Gotcha. Let me jot that down. All right. Yep. Okay. Let me talk first about U.S. versus international. If you were to ask me what does better over the next 10 years, I'd tell you international. We know that the U.S. market's been the best show in town. Everybody's been hit by what's going on right now. So let's say we backpedal 2 months. If you look at the numbers, the U.S. wasn't a bubble in the stock market by any stretch, but it certainly was far more expensive. And if you look at the broad opportunity set of what's out there around the world, the foreign markets, from a projected growth standpoint in their economies, coupled with their valuations, look more attractive. So now, granted, look, we're going to be reevaluating that, but I would suggest that probably still holds true. But let me couch that with one really important point. If you look historically at a range of asset classes, look at U.S., foreign, emerging markets, bonds, REITs, all these different things. The one thing that is always true is there's a constant interchanging of leadership as far as performance goes. So there's no silver bullet, and there's no, just like market timing, you can't dive in and just say, I'm going to go all international now because Aaron said that's what's going to do best. We've done a ton of research into this. And what we found is that the optimal balance is really about 60% domestic exposure and about 40% foreign exposure. That balance will kind of optimize your return and risk projection. And we think that's the right way to think about it. The US dollar, look, I'm not an expert on currency or currency fluctuation. The one thing I would say, though, and this has continued to be the case, we've seen the US dollar has been creeping up, and a lot of it has to do with we're still the safest show in town. And so long as that holds true, and frankly, I don't see any reason I don't see any catalyst that changes that right now. Even with massive paper being issued to fund all these different stimulus programs, you still want to own our debt. And that was true even before this crisis. I mean, look, if you had to choose between developed economies and park your cash somewhere to protect it, did you want to own a 10-year treasury that, again, I know is yielding not much today, or did you want to go buy a German bond, which was actually a negative yield? So you give them your money, you got less back. You paid for the right for them to have your money. So the fact that we still have these rates that are going to be elevated relative to pretty much everywhere else in the world, that will be supportive of our dollar.
Yeah, I think there's some relevancy with respect to the overall U.S. economy when you look at the demographic trends. So when you look at, say, Japan and how their economy has been in kind of this perpetual state of flat to slightly down, and some of these other countries, they have some real demographic issues, right, in terms of aging population and how that impacts overall consumer spending. And when you look at, or at least when I've looked at the demographic trends in the U.S., they're favorable out to 2050, absent some material change, right? And so that's largely factored into kind of this overall sense that for the next 2 to 3 decades, as long as the demographic trends stay favorable, that the U.S. continues to be kind of in the power position, subject to some material thing. Yeah, go ahead.
Well, I was just saying, yeah, and look, and the only real challenger that's ever existed for quite a while now has been China, but they've never really made much headway into replacing us as the reserve country, for reserve currency and storing paper. Because it's, at the end of the day, there's still a lot of concern around the structure of their government. Are you really getting clear facts, accurate data? There's far too many concerns, I think, underpinning that economy that would lead people to hesitate at suddenly saying, yeah, that's going to be the place to store my capital and protect it. So yeah, to your point, right, I still think we're in pole position to retain that spot for quite a while, and that in and of itself will be supportive of the dollar.
Okay.
Cool. You ready for another?
Fire away.
Do you not believe that the countries who have acted more aggressively are further ahead in the curve, will perform better in the second half of this year than the U.S.? Our projections show the economic freeze in the U.S. may well last into the third quarter, whereas other territories are readying to reopen in a matter of weeks.
No, I think there's some truth to that. Look, I think some other, you've seen examples, South Korea has taken a very targeted approach to testing and containment. Look, I know there's a lot of debate around the data out of China, but they took a very heavy-handed quarantine approach, and you are seeing their economy start to spin up. Look, you're seeing improvement in the numbers in Italy. I know it's a very challenging situation, but yeah, look, I think there's some truth to the fact that if some of these other places are able to move beyond this quicker, that they'll be in a better position. Now, we have to bear in mind that it is a globalized economy. I talked about China starting to spin up their economy. That's true, but using them as the example, right? They're also still predominantly an exporter, and who's going to buy, right? A lot of the economy around the world is still on lockdown. So while they are starting to pick up activity, progressively, yes, we need the entire world to start to grow again. But I think there's very much some truth to that question, that yes, some other markets may pick up sooner than the U.S. just on account of the fact that they're probably further along than us in this process.
Yep, that makes sense. Do you have a view on USD versus GBP for the rest of the year, forecast for the rest of the year?
Oh, versus the British pound?
Yeah, British pound.
GBP. Yeah. I really don't. Again, that's just not an area of my expertise, so I'd just be guessing if I took a stance there. The one thing I would say goes back to my bigger point is that, again, just U.S. dollar is going to continue to be the reserve currency for the time being, and we're seeing more and more data suggest that the UK is they're struggling right now with the pandemic. They're starting to really recognize that they are behind the curve. Just bearing that in mind, it probably suggests that the U.S. dollar continues to get strength, but again, that's just me speculating.
Cool. The rest looks like stuff for Dan with the loan and the PPP.
Cool.
I'll leave that one to you, Dan.
You want to jump in and walk through the process for applying for the PPP?
We actually, well, by the way, so I'll holster my modest, my modest position about our firm, because I talked about that research group earlier, and like you've met Richard Weaver, for example, is a national managing director that heads up our practice centered on working with business leaders. So he's actually put together a lot of thought leadership in the last couple of days around all the provisions, and in particular the PPP loans and what's come out of that. So. Full disclosure, I actually literally got a bunch of that information yesterday. I haven't dug through all of it myself, but I think we are going to be trying to just project some information and just, obviously do the things that we can be helpful in that space. So yeah, it's something that we're familiar with, but yeah, I'm not an expert.
Well, I look forward to going through that research that you guys have.
Of course.
Well, thanks for coming on. Appreciate it. And we'll catch up soon.
My pleasure. Yeah. I'll send you, by the way. Oh, yeah, of course. No, thank you. And I'll send you guys, I just thought, we have a podcast we put out, and like there was our senior U.S. economist, Eric Winograd, just did a podcast at the end of last week. And it's on a lot of the points that I was talking about, but I'll shoot you the link. And then that way, if anybody's interested, they can take a look at it, because it's good stuff. And with what's going on right now, we're obviously pumping out as much intellectual collateral as we can as often as possible. So I'll send it your way. You can share with folks.
Yeah, real quick, what is the name of the podcast? Do you have it off the top of your head?
Oh, Pulse. Bernstein Insights. There's a couple of subcategories. Sorry, so I always forget the primary name. Now I'm just looking it up.
Is it on iTunes and stuff, or is it through your guys?
Yep.
Oh.
Yeah, it's on iTunes. Just make sure I got I think it's Bernstein Insights. If this thing will load. There we go. Yeah, Bernstein.
Go ahead. Sorry.
Oh, so yeah, Bernstein Insights.
Cool.
So I'll send you the link for that. Of course, my pleasure.
Appreciate it about your recent live stuff. Is normally it's so polished, so I've really enjoyed seeing all the like managing directors in their home offices with like trying to figure out the camera angle just right, and it's been great. Normally they're so polished, so it's been kind of fun to see these.
You know me, this is a treat, right? I'm not wearing a suit. This is these are it's real strange days when I'm not throwing the suit on. So yeah.
Totally. Great. Well, thanks again for coming on. We'll let you go, and we'll switch gears and talk about the PPP and that process and all your guys' questions on disaster loans. So thanks, Aaron.
Sounds good. Thanks, guys.
All right. Talk soon.